You've been told corporate fraud gets caught quickly. The Olympus accounting scandal lasted 20 years before anyone outside the company knew. You watch a 90-year-old camera and medical equipment maker post steady profits, year after year, decade after decade. You see nothing unusual in the filings. You don't see the $1.7 billion in losses sitting just beneath the surface, hidden since the late 1980s. The official explanation, when it finally arrived, described a rogue scheme by a handful of executives. The mechanism sits elsewhere, in the specific financial tools Japan's market structure made available, and in a corporate culture engineered to never let a senior executive admit failure. This is a story about loss concealment. What happens when an institution treats an honest balance sheet as a greater threat than the losses themselves? In the late 1980s, Olympus, like many Japanese corporations, used the strength of the yen and easy credit to move into financial speculation, a practice known in Japan as Zaitech, or financial engineering, where companies treated their balance sheets as investment vehicles alongside their actual business operations. Olympus poured corporate funds into securities, derivatives, and risky financial instruments, chasing returns well outside its core competency of manufacturing. You see a camera company behaving like a hedge fund. You see executives confident the bull market would never end. Then the Japanese asset price bubble collapsed beginning in 1990. The Nikkei lost roughly half its value within 3 years. Olympus's speculative portfolio, like those of hundreds of other Japanese firms, was suddenly underwater by a figure executives considered catastrophic to disclose. Here is what that pattern historically produced. Charles Kindleberger's manias, panics, and crashes, 1978, documented a recurring stage in financial cycles. After the speculative mania breaks, the actors who built the exposure face a choice between admitting the loss and finding a way to defer it. Olympus chose deferral, and Japan's regulatory and accounting environment at the time gave that choice an unusually long runway. But the more important mechanism is this. Japanese accounting rules through the 1990s permitted companies to value certain assets, including securities holdings, at historical cost rather than current market value. This meant a company could hold a security that had collapsed in market price while still carrying it on the books at what it originally paid. The losses existed. They simply weren't required to appear. You see a regulatory environment built around stability and creditor relationships, not aggressive mark-to-market transparency. You see that environment, designed to prevent panic, becoming the exact mechanism that allowed concealment to persist. This is regulatory arbitrage in its most patient form, not exploiting a loophole for a single transaction, but exploiting a structural feature of an entire accounting regime for 2 decades. Olympus executives, led at the time by managers who would later be identified in court filings as central to the scheme, began using a technique that financial investigators would later call tobashi, a Japanese term referring to the practice of offloading impaired assets to outside entities, often at inflated valuations, to keep them off the parent company's books. Tobashi schemes became common among Japanese firms managing post-bubble losses through the 1990s, but most were unwound as accounting standards tightened. Olympus's persisted. The deeper question is not how the losses were first hidden. The deeper question is why the concealment kept working for 20 years, across multiple changes in leadership, multiple audit cycles, and a major shift in Japanese accounting standards that was specifically designed to close this exact gap. Here is the structural answer. Beginning in the early 2000s, Japan moved toward mark-to-market accounting for securities, a reform explicitly intended to prevent exactly the kind of concealed losses Olympus was carrying. Rather than unwind the losses, and absorb the hit, Olympus restructured the concealment. The company transferred the impaired assets into off-balance sheet investment funds, often domiciled in the Cayman Islands, and used a series of acquisitions to funnel money toward absorbing the hidden losses without ever formally recognizing them. You watch Olympus acquire a British medical equipment maker, Gyrus Group, in 2008 for approximately $2 billion. You watch the company pay roughly $687 million in advisory fees to obscure intermediary firms registered in the Cayman Islands, a fee structure that independent analysts later estimated at more than 30 times typical advisory rates for a transaction of that size. Who benefits in a structure like this? The intermediary entities receiving inflated fees, many of which were later found to be controlled by parties connected to the original concealment scheme. Who absorbs the risk? Shareholders, who had no visibility into why acquisition costs were so disproportionate to comparable deals. Who gains time? Executives who needed the acquisition fees to function as a channel for quietly transferring value to cover decades-old losses. Who carries the cost? Investors, and eventually, the company's own survival as an independent entity. This is the Cantillon effect again, but inverted. Richard Cantillon's original insight described how those closest to new money creation capture value first. At Olympus, those closest to the concealment apparatus, the executives managing the offshore funds and the intermediaries processing the fee transfers, captured the ability to control information, which functioned as its own form of advantage, even without new capital entering the system. You see a major, multinational acquisition. You see board approval. You see auditors signing off. You don't see anyone asking why the fees were 40 times market rate. This is where the historical record becomes useful. Compare Olympus to Barings Bank in 1995, where a single derivatives trader, Nick Leeson, concealed mounting losses in an error account for years before the bank collapsed. The mechanism was structurally similar, losses hidden through an accounting mechanism designed for a different purpose, growing silently because no internal control was positioned to catch them. The difference at Olympus was scale and duration. Barings unwound in roughly 3 years and destroyed the institution. Olympus stretched the same basic concealment logic across 2 decades and multiple changes in executive leadership, because the losses were distributed across acquisition structures rather than concentrated in one trading desk. The deeper question is why it keeps happening. Hyman Minsky's Stabilizing an Unstable Economy, 1986, argued that financial systems generate their own instability through a process where confidence breeds increasingly fragile risk-taking. Olympus's case extends that logic into corporate governance. Institutional confidence in senior leadership, reinforced by decades of steady reported profits, created exactly the conditions where nobody inside the company had the standing to question the numbers. You watch the company's board approve transaction after transaction. You watch external auditors rotate through the engagement without raising red flags that would later seem, in hindsight, difficult to miss. The scandal became public not because regulators caught it, and not because auditors caught it. It became public because of one person, Michael Woodford, a British executive who had spent over 30 years at Olympus and was appointed president and CEO in 2011, the first non-Japanese national to hold the role. Within weeks of his appointment, Woodford began investigating the unusually large fees connected to the Gyrus acquisition and other deals, after reading an article in a Japanese magazine, Factor, that raised questions about the payments. You see a newly appointed CEO ask a basic question about a large advisory fee. You see that question, within 2 weeks, end his employment. On October 14, 2011, Olympus's board voted unanimously to remove Woodford from his position, citing vague management-style concerns and providing no specific explanation tied to the financial questions he had raised. Woodford went public immediately, taking his concerns to the Japanese and international press, and later to the Serious Fraud Office in the United Kingdom and the FBI in the United States. This is reflexivity in George Soros's sense, the way perception and reality feed back into each other in financial markets. For 20 years, the perception of Olympus as a stable, conservatively managed manufacturer reinforced a reality where nobody looked closely enough to test that perception. The moment one credible insider broke that feedback loop, the entire structure that had depended on unchallenged perception collapsed within months. You watch Olympus's stock price fall by more than 75% in the weeks following Woodford's dismissal and the subsequent public allegations. You watch a company that had spent 2 decades managing its losses, one acquisition at a time, lose more market value in a few weeks than it had spent the entire period trying to conceal. According to the findings of an independent third-party investigative committee that Olympus itself commissioned under public and regulatory pressure, the company concealed losses totaling approximately 117.7 billion yen, or roughly $1.7 billion at contemporary exchange rates, accumulated from the early 1990s through 2011. The committee's December 2011 report identified the core scheme as orchestrated by a small group of senior executives, including former Chairman Tsuyoshi Kikukawa, who had been central to the concealment since its origins in the post-bubble period. The deeper question is not what these individuals did. The deeper question is what allowed the structure to remain intact across multiple CEOs, multiple audit firms, and a complete generational turnover in middle management, none of whom independently surfaced the issue. Here is the structural answer financial historians point to. Japanese corporate governance through this period was characterized by what researchers, including those cited in subsequent OECD corporate governance reviews of Japan, identified as weak board independence, boards composed overwhelmingly of internal executives with limited outside directors, limited shareholder activism, and a cultural premium on consensus and deference to senior leadership that discouraged internal challenge. Olympus's board, prior to the scandal, had no truly independent directors with the standing or information access to question senior management's financial decisions. You see a board structure designed around harmony. You see that same structure unable to perform its most basic function, catching a fraud being run by the people sitting in the room. Carmen Reinhardt and Kenneth Rogoff's This Time is Different, 2009, found that financial crises recur in part because each generation of market participants assumes the specific safeguards of its era are sufficient. Japan's post-bubble accounting reforms were a genuine attempt to prevent exactly this kind of concealment. Olympus's 20-year run shows that closing one loophole, historical cost accounting, simply redirected the same underlying behavior into a new mechanism, offshore funds and inflated acquisition fees. The incentive to conceal didn't disappear when the original tool was removed. It found a new tool. This is the reframe that matters. Financial concealment is not a static technique. It is a moving target that adapts to whatever the prevailing regulatory architecture leaves available. Mark-to-market rules closed one door. Cross-border acquisition structures, with limited transparency into offshore fee arrangements, opened another. Who gained optionality throughout this 20-year period? The executives managing the concealment, who retained the ability to defer recognition indefinitely as long as new acquisitions could generate fresh channels for absorbing old losses. Who gained purchasing power, in a sense, from the arrangement. The intermediary entities receiving fees dramatically above market rate, extracting value with minimal scrutiny, who absorbed the risk the entire time without knowing it. Shareholders and employees, whose equity and pensions were tied to a company whose reported financial health had been substantially fictional for 2 decades. In 2012, Olympus reached a settlement and recapitalization, including a significant capital injection from Sony, which acquired roughly an 11% stake to help stabilize the company's balance sheet and preserve a long-standing business relationship in medical imaging technology. Japanese prosecutors brought criminal charges against several former executives. In 2013, a Tokyo court convicted Kikukawa and 2 other former executives of falsifying financial statements, though the sentences, suspended prison terms, drew significant criticism internationally as disproportionately lenient relative to the scale of the fraud. You watch a $1.7 billion concealment scheme result in suspended sentences. You notice the punishment doesn't scale with the duration or magnitude of the deception. You recognize that the deterrent effect of corporate fraud enforcement depends not just on whether wrongdoing is eventually caught, but on whether the consequences meaningfully exceed the benefit of having concealed it for 20 years in the first place. Adam Tooze crashed, 2018, while focused primarily on the 2008 financial crisis, makes an argument that extends cleanly to Olympus. Financial systems do not fail because no one understands the risk. They fail because the people who understand the risk most clearly are frequently the same people positioned to benefit from delaying its recognition. At Olympus, the executives who built the original concealment in the 1990s were not naive about the eventual consequences. They were making a calculated bet that the cost of admission at any given point exceeded the cost of continued deferral, a bet that worked structurally for 2 decades. You see this same logic appear far beyond Japan, far beyond cameras and medical devices. Enron's off-balance sheet special-purpose entities in the early 2000s served a nearly identical function, moving liabilities somewhere auditors and investors couldn't easily see them, justified internally as temporary, sustained because no internal mechanism forced reconciliation. The deeper pattern beneath Olympus, and beneath concealment schemes generally, is this. The duration of a fraud is not primarily a function of its complexity. It is a function of how long an institution's culture can suppress the one person whose job, formally or informally, is to ask an inconvenient question. Olympus had functioning audit committees. It had external auditors. It had, eventually, even a foreign CEO with no personal stake in protecting the original scheme. What it lacked for 20 years was a structure that gave any of those parties enough independent standing to act on what they found before being removed. You won't just watch the next rogue executive corporate fraud headline as an isolated personal failing. You'll be watching for the structural question underneath it. How long had the company's information environment made it costly, professionally or personally, for an insider to surface what they already suspected? The next time you hear about a sudden CEO departure, a disproportionately large advisory fee, or a management-style dispute used to explain an executive exit, you won't just be watching the stated reason. You'll be watching the incentives that made the real reason too costly to say out loud. If you want more videos like this, subscribe.